If you earn a lot of money and have a high income, then this is going to be super helpful for you. One of the biggest issues about earning a high income is the more money you earn, the more taxes you're paying. So how do I increase my income without increasing my taxes? Obviously legally. That's what we're going to talk about today. We're going to talk about how to increase your income without increasing your taxes, and doing so through the layering method of real estate investments. For those of you who don't know me, I'm Alex Kingman with KGI Capital, and we invest in heavy value add or distressed multifamily properties in the Midwest and the Southeast. Before we get into it, I'm a real estate investment professional, not a CPA. So always make sure to discuss any strategies with your CPA, and that way you can take full advantage of this and implement it into your own strategy. Typically, when somebody invests into a real estate syndication as a limited partner, which is the passive investor, they are receiving these pass-through paper losses from the property. But in most circumstances, they are not able to write that passive loss off against their active W-2 or business income. Because of this, the passive paper losses that they receive from these multifamily properties they're invested in become a suspended passive loss, meaning that you can take this passive loss and use it in future years if you don't use it this year. So you can carry it over to the next year and the next year and the next year until you're able to use it all up. It's also important to note that while in like 98% of circumstances you can't write off your passive losses against your active income, you can write off your passive losses against any of your passive income that you have coming in. And this is where the layering strategy can help you. So what do I mean by layering investments? Let's break it down with an example. Let's say in year one, you invest $100,000 into a syndication and receive a $90,000 loss passed back to you due to bonus depreciation from the cost segregation study that was done. Let's say you don't have any passive income that's coming in from that year, so you get a $90,000 suspended passive loss in your tax returns. Fast forward to year two, you invest another $100,000 and receive another $90,000 loss. Year three, you invest $100,000 again, maybe receiving $85,000 back due to bonus depreciation starting to phase out. However, there is something in the works right now that would bring bonus depreciation back to 100%. So stay tuned for that. But for the sake of this example, let's just assume that it's going to continue phasing out. Year four, you invest another $100,000 and get $70,000 passed back to you. Now we've accumulated $335,000 in total losses that you haven't been able to use against any of your income. And as a side note, if you are totally lost as to how we got these passive losses in the first place, I encourage you to look into bonus depreciation and how that works. In our investments, we take advantage of bonus depreciation, especially because we're doing a lot of heavy lifts. And so it is a great benefit for especially the strategy that we employ. So we've accumulated $335,000 in total losses that are just suspended, waiting for us to be able to use. So here is where the magic happens. In year five, you decide not to invest another $100,000 and your first syndication liquidates. That syndication allocates a $150,000 gain to you. You've got $335,000 of total losses, which you can use to offset that gain. The next year, year six, your next syndication liquidates with another $150,000 gain. You use the remaining $185,000 of suspended passive losses, leaving you with $35,000 left of suspended passive losses. So up to this point, you have been able to exit your first properties without having to pay any taxes on your gains. The next deal liquidates with a $150,000 gain. And after factoring in your remaining losses, you're left with zero suspended passive losses and a total gain of $115,000. Now you have a decision to make. You can either invest in another syndication to create more tax losses to offset the gain, or you can just take the tax hit on the $115,000 gain, or there are other strategies as well. By layering your deals strategically, you can delay paying taxes for years, as you can see with this example. So consider using this strategy. Talk to your financial advisor or your CPA, talk to your sponsors, about timing and expected losses so that you can optimize your tax strategy and so that you can earn more income without paying more taxes. Ultimately, our goal for you guys is to be able to create lasting legacy wealth and to be able to have the freedom to live life on your terms. Thanks so much for watching, and we have more videos like this coming out soon. So stay tuned and we will see you in the next one.